Hey everyone, happy Tax Talk Tuesday. Now it's been a little while since we've done one of these, so I wanted to bring you back into the tax fold a little bit by talking today about a tool that some of our clients really like to use, and that is called a 1031 or a like-kind exchange. So the first question you probably have is, what is a like-kind exchange? And that is the purpose of this video. And then next week, we'll have a second video dealing with some recent changes, recent regulations that have really clarified some of the definitions used in 1031 exchanges. But today, just want to give a brief overview of how a 1031 exchange works. And first of all, what a 1031 exchange even is. So to that first point, what is a 1031 or a like-kind exchange? Well, quite frankly, it is all in the name. It is an exchange of one piece of property for another. There are tax reasons for doing an exchange versus a sale and then buying new property. And after the Tax Cuts and Jobs Act of 2017, the only property that this will work for is business or investment real property. So can't do this with personal property, can't do this with intangible personal property. There's certain intangibles that can qualify as real property, and that's something we'll cover in that other video. But again, like-kind exchange is a swap of one piece of real property for another. And really, it's not that limited. It doesn't have to be one piece for another. It can be multiple pieces of real property for multiple pieces of real property. And actually, it's kind of a liberal definition. You can exchange rental property, for example, for raw land, or raw land for an apartment complex. I don't want to say the possibilities are endless, but there are a number of different combinations that you can go through when you're swapping one property for another. Why on earth would you want to swap property instead of just selling it and then buying new property? Well, under a 1031 exchange, you take your current property and working through what's called a qualified intermediary, exchange that property for new property. And as a result, the gain, any gain that you have in your existing property is deferred. So in short, you're not paying any capital gains tax at the time that you acquire the new property, which is contrary to when you sell property outright. So for example, let's just say that you bought a rental property worth $100,000 a few years ago. It's now worth $300,000. If you were to go out on the street, sell that property, you've got $200,000 worth of gain that you have to deal with in some way, shape, or form. If you go through this like-kind exchange program, you actually, again, you're working through a qualified intermediary unless you can find someone out there who literally will swap your real property for their real property. But 99 times out of 100, you're going to work through this qualified intermediary who will, through something called an exchange agreement, acquire your property, sell it to a third party. The funds from that sale are held by the qualified intermediary, who then purchases the new property that you want, and that property is transferred back from the qualified intermediary to you. So let's just say from that example, if you purchased a piece of raw land worth $300,000, or that was the newly acquired property, the basis in that newly acquired property is not going to be $300,000, which was the price of the property. It's going to be the $100,000 that you had in your previous rental property that was swapped through this exchange. But instead of paying capital gains on that $200,000, you're not going to pay capital gains yet. You will pay it down the line if you ever sell that property. But at least under current law, that capital gain is deferred. And using other laws that are on the books, you can sell that property at a more tax advantage time. Maybe you have losses that will make up for that capital gain. Or at least under current law, if you pass away, your heirs, your beneficiaries may receive a step up in basis and capital gains may never get paid. So that is a big, and the biggest reason why anyone does a like-kind exchange is to defer the capital gains on property that they currently have that they no longer desire to keep, and they acquire new property by transferring that basis over to that new property. That sounds relatively straightforward, and it is if you adhere to and stick to a pretty strict process. And so what I mean by that and how this process works is, I've already mentioned you work through a qualified intermediary. So let's just say you've started that process and your property that you currently own sells. It goes through closing. Well, within 45 days, so the first rule that we have to stick with under a general 1031 exchange is you have 45 days from that closing to identify what's called replacement property. And you have to identify that in writing, specifically and unambiguously to the qualified intermediary. And the qualified intermediary will then purchase the property that you've identified, or at least some of the property that you've identified. And that closing on the new property must occur, this is the second rule, within 180 days from the closing of the first property. So that 45-day and 180-day timeline is actually running concurrently. So let's just say that you identify property on the 45th day, the last day of that first deadline. You actually only have 135 days from that point to close on the new property. But if you stick with that under a general 1031 exchange, you work through a qualified intermediary, you never touch the funds from the sale of your current property, and those funds are used to purchase the new property, you have deferred capital gains. Now, 1031 exchanges come in a whole array of shapes and sizes. You can do reverse exchanges. There are many things to consider here, but generally speaking, you follow that process. You transfer the basis in your current property to the new property through this swap, this exchange. And again, it's a tax deferral technique. It's a tax planning technique. I mentioned that there's a lot of different ways to do this. One other thing just to be aware of, and something that we'll touch on in the next video, is that real property, it includes more than just real estate, raw land. But the IRS did clarify that personal property, things like appliances that are in place, things like detached sheds and carports, some of these things may not be considered part of the real estate. It all depends on how they're affixed to the land. And if that's the case, you may not get to recognize a full, or you may not, it's not right to say that you won't realize any gain in this transaction. It just requires itemizing the parts and pieces of the land, if you will. Again, we're going to touch on that in this next video, but wanted to just introduce you to the idea of this 1031 exchange today. So swapping property, resulting in a deferral of some or all of the capital gains associated with that property. Again, great tool. We're happy to talk a little bit more about this with you if you have any questions. Check back next week for that second video. And just to note that we've got some exciting things coming. Hopefully get some more people involved in these Tax Talk Tuesdays so you don't just have to look at me. But until next week, I do hope you have a great rest of your week, and thanks for checking this video out.